Welcome back to the channel. I'm Algabot, and today we're taking an educational look at a MetaTrader 5 expert advisor called the Internal Strength Divergence Fade. This is a counter-trend, exhaustion reversal approach, and it's built around an idea most oscillator strategies completely ignore, not just where price is going, but where each candle actually closes inside its own range. Over the next few minutes, we'll unpack the concept, walk through the exact entry and exit rules, read the real MetaTrader code together, and then illustrate a long and a short example on a chart. Remember, this is educational information only, never financial advice. Let's dive in. So what is the core idea here? Most reversal systems watch an oscillator like a stochastic or an RSI. This strategy instead looks at something more granular. For every closed candle, it measures the close location value. That's the close minus the low divided by the full high to low range. The result is a number between 0 and 1. When it sits near 1, the bar closed right up on its high, meaning buyers own the close. When it sits near 0, the bar closed down on its low, meaning sellers owned it. The strategy smooths that value into a single line it calls internal strength. Now here's the tell it's hunting for. In a healthy up move, price rises and bars keep closing high inside their range. Strength rises right alongside price. The warning sign of exhaustion is when price keeps grinding out higher closes, but that internal strength line is quietly falling. Each new high is being sold into, and closes are creeping back toward the lows. That's bearish divergence at a top, and the strategy fades it with a short. The mirror image, price making lower closes while internal strength lifts, because sellers can no longer close price on the lows, is bullish divergence at a bottom, and the strategy fades that with a long. The divergence itself is measured carefully and without repainting, using least square slopes over a lookback window. The price slope is normalized into ATR per bar units, so the same threshold behaves consistently across different symbols and timeframes, while the strength line slope is measured in its own units. The two must be running in opposite directions. This approach was built with pairs like euro to US dollar and pound sterling to Japanese yen, and with gold, on the 15-minute to 1-hour charts in mind, though it reads only the chart you attach it to. It's suited to a trader who is curious about mean reversion and exhaustion logic, and who wants to study a disciplined, rules-based reversal engine rather than chase trends. And of course, trading always involves risk, and losses do occur. Let's walk through the mechanics step by step. On every newly closed bar, the strategy first computes that close location value we discussed, close minus low, over the high to low range. It feeds that into an exponential moving average, controlled by the StrengthSmooth parameter, which defaults to 5. That gives us the smoothed internal strength line. Next, it looks back over a window set by the Lookback parameter, defaulting to 20 bars. Across that window, it calculates two least square slopes. The first is the slope of closing price, then divided by the current ATR, so it's expressed in ATR units per bar. The second is the slope of the internal strength line. It also checks the average true range over the ATR period, defaulting to 14, which it uses both for normalization and for stop placement. Now the entry conditions. For a short, the strategy signals a bearish divergence when four things line up at once. The price slope must be rising by at least the minimum price slope, which defaults to 0.05. The strength slope must be falling by at least the minimum strength slope, defaulting to 0.01. Price must be sitting near the top of the lookback range, controlled by the extreme fraction of 0.7. And finally, the most recent bar must close on the weak side of its own range, below the midpoint of 1/2. When all four agree, the EA sells. The long is the exact mirror. Price slope falling, strength slope rising, price near the bottom of the window, and the latest bar closing strong, above 1/2. When those align, the EA buys. Risk is handled structurally. On a short, the stop loss is placed just above the faded swing high, with an ATR buffer set by the stop loss buffer ATR parameter of 1/2. On a long, it goes just below the faded swing low. The take profit is then set at a multiple of that stop distance, defined by the RewardRisk parameter, which defaults to 1.8. There's an optional ATR trailing lock that only ever ratchets in the trade's favor. The EA holds just one position at a time, and a cooldown of 3 bar spaces entries apart. Let's read the MetaTrader code the way we'd see it in MetaEditor. At the top are the inputs. Lookback sets the slope and extreme window at 20. StrengthSmooth is the exponential moving average period for the internal strength line. Minimum price slope and minimum strength slope are the two thresholds the divergence must beat. Extreme fraction, at 0.7, decides how close to the window's edge price must sit. Stop-loss buffer ATR and RewardRisk shape the exit, and cool-down bar spaces trades apart. Now the short block, labeled Bear Div. Read the four conditions joined by logical ands. The price slope must be at or above the minimum price slope, so price is climbing. The strength slope must be at or below the negative minimum strength slope, so internal strength is falling. Range position must be at or above the extreme fraction, meaning price is near the top of the window. And the last close location value must be under 0.5, a weak close. When all are true, the stop is set above the faded high plus an ATR buffer. The take profit is placed at the reward to risk multiple of that distance, and trade.sell fires. The long block, Bull Div, mirrors it exactly. Price slope falling, strength slope rising, range position near the bottom, and the last close location value above 0.5, a strong close. Then the stop goes below the faded low. The take profit is the reward to risk multiple above entry, and trade.buy sends the order. Same skeleton, opposite direction. Let's bring this to life on the chart, and we'll take it candle by candle. The panel underneath price is the internal strength line, the smooth close location value, running between 0 and 1, with a dashed midline at 0.5 that separates weak closes from strong ones. Watch how it diverges from price. That's the whole game. Start on the left. The first few candles are falling. Price is stepping lower, printing lower lows and lower closes, a clear down move. But look carefully at where each candle closes inside its own body. On the very first bars, closes are jammed down near the lows, and the strength line sits low, around 0.15. As we move right through the down move, though, something changes. Price is still falling, yet each successive candle is closing a little higher within its own range. By the fourth and fifth candles, price has reached a fresh low, but the bars are closing up near their highs. Sellers can push price down, but they can no longer close it on the lows. See how the strength line has been climbing the entire time, lifting past the midline towards 0.55. Price down, strength up. That is textbook bullish divergence at a bottom. At the fifth candle, all four of the strategy's long conditions line up. The price slope is negative and past its threshold. The strength slope is positive and past its threshold. Price is sitting near the bottom of the look-back window, and that last bar closed strong, above the midline. The buy entry marker prints, and the protective stop is tucked just below the faded swing low. From there, follow the move. The next candles reverse cleanly upward. The sixth, seventh, and eighth bars each close near their highs and stack higher. By the ninth candle, price reaches the take profit target, set at the reward to risk multiple of 1.8 above the entry. The long trade is complete. Now the market keeps pushing higher, and this is where the mirror setup builds. Candles 10, 11, and 12 grind out higher highs. Price is clearly still marching up. But watch the strength line now. It has rolled over and is falling hard, dropping from near 0.8 back down through the midline. Each new high is being sold into. By the 12th candle, price prints its highest high of the sequence. Yet that candle closes weak, down near its low, below the midline. Price up, strength down, bearish divergence at a top. That 12th candle is where the short conditions all agree. Price slope positive and past threshold, strength slope negative and past threshold. Price near the top of the window, and a weak close under 1/2. The sell entry marker fires, with the stop placed just above the faded swing high. Then price rolls over exactly as the exhaustion signal suggested. Candles 13, 14, and 15 close progressively lower, and by the final candle price reaches the short take profit target, again at that same reward to risk multiple below entry. Two trades, both faded against the immediate move, both driven by the quiet disagreement between price and internal strength. And that wraps up our educational look at the internal strength divergence fade. We covered its core idea, fading the divergence between price and where candles close inside their own range. Then walked the entry and exit rules, Read the actual MetaTrader code for both the long and short sides, and illustrated each trade on the chart. Remember, everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation. Trading carries real risk, and losses do happen, so always study, test carefully, and manage risk responsibly. If you found this breakdown useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and drop a comment telling me which strategy you'd like explored next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.